Hello, and welcome to today's life insurance and taxation modules exam prep bootcamp. My name is Sam Aldean, and I will be your instructor today. As always, I will try to answer all your questions as we go along. But remember that I can't obviously give you too much detail, but I will certainly do my best. But remember that after the session, you can always go back to your email address that's on your contact page of your website and email me, and I will be more than happy to respond within. Usually, we will respond within 24 to 48 hours. We do get quite a few of them, so we certainly welcome them. So you're more than welcome to email me after the facts and everything else. But in the meantime, like I said, I will do the best I can to answer them as we go along. Like we've done in the past, obviously for any of you who attended these sessions before, we're obviously going to review the content, clarify probably any ideas that concepts you may have, and of course, as we go along, answer any questions and everything. So the first thing we're going to do, because we are talking about money, obviously, the very first thing we're going to do is we're going to talk about the whole concept of before and after tax dollars. Okay, this is of course something that most people seem to have a difficulty with. So to put it in sort of context, when you get your paycheck from your employer, let's say, and he shows the top line, whatever it is, $1,000, whatever, and then you actually see the actual amount in your check, and you notice that it's like, say, it's like $700. Well, that $700 is really your after-tax dollars, essentially. That's really what we're talking about. Okay? However, when we talk about investments, we do have to talk about before and after-tax dollars. So in our example that's in front of you right now, let's assume that you wanted to invest $100. In other words, or you bought an insurance policy that with $100 a month premium or something. So the obvious thing is, well, how much money do I have to earn on a gross level in order for me to actually have $100 in my pocket so that I can pay this premium? And let's again assume that your average, your tax bracket, let's say, is 30%. Which is fairly consistent with the vast majority of the population of Canada, because the vast majority are in a 30% tax bracket. That means that basically 30% of the money is gone before you even see it, and all you've got left to spend is really 70%. So the question obviously is, well, if I want to pay $100 premium, how much money do I have to earn on a gross level in order to get $100? Well, it's really quite simple. Take the $100, divide it by 70%, because that's all you get to keep, basically. And you notice in our example that we have $142.85. In other words, in order for you to pay your $100 premium a month, let's say, you need to earn $142.85 to make that possible. That's essentially what we're saying. The second kind of income, of course, that we'll refer to as before tax dollars. And this usually happens before deductions. In other words, you can't deduct the premium, you can't deduct. Later on, we'll talk about registered money, non-registered money, that kind of stuff there. So usually when we talk about deductions, basically that is the before tax dollar. So in other words, if you were in fact had a $100 premium, but you were able to deduct that $100 premium against income and everything else, then that basically means there's no tax that has to be paid. So $100 is in fact a real $100. So therefore, $100 before tax is $100 before tax, period, because you are deducting it. Whereas in the first example, the $100 is after tax. That means you have to earn $142 in order to make basically $100 in investment. So I hope that clarifies a little bit of that anyways. For the most part, in our when we talk about life insurance, we're usually talking about after-tax dollars. When we talk about investment dollars, for example, for RRSP purposes and everything else, we will be talking about before tax dollars. But we will have sessions on that later. For now, let's just focus our attention on the after-tax dollars. Okay? So again, staying with that sort of deductibility of the premium, the premium that you pay for your insurance policy is always after-tax dollars. In other words, you as an individual policyholder, or even if a company, let's say, owned a policy on your life, it would always be with after-tax dollars. And the reason for that is because we want the benefit that's paid out to you tax-free. So if, for example, you insured yourself for $500,000, and let's say it was before tax dollars, that means then that at the time of death, that 500,000 could be taxable. Well, the last thing your beneficiary wants is a big tax bill. That's why premiums are always after tax dollars, whether it's policies owned by an individual, in other words, you, or your company owns a policy on you. It's always with after tax dollars. That way, when the $500,000 gets paid out, it will be totally tax free. The other area you have to look at is group insurance. Some of you may be employed where there is a group insurance plan. And again, we'll talk about group insurance in a later session, but for our purposes today, basically the employer pays the premium on your behalf, and of course deducts it from their expenses and everything else. However, this is the tricky part. It will show that deduction as a taxable benefit to you as the employee. So once again, if we go back to that $100 that we were talking about, basically what we're saying, yes, they can deduct $100. That's not a problem. But that $100 will show up as a taxable benefit to you. In other words, when things show up on your T4 as a taxable benefit, the reality is it's not the employer that's actually paying for it. You're actually paying for it yourself. And the reason, again, why we do that is because, once again, when you die and the $100,000 benefit, let's say from your group insurance death benefit paid for your beneficiary, you want that beneficiary to receive that money tax-free. If the employer did not show that $100 as a taxable benefit to you, that means that the other way, when you passed away, obviously your beneficiary is going to get $100,000, but it will be taxable income. And again, that's the last thing that a person receiving a death benefit wants. They want it totally tax-free. So once again, when we are talking about life insurance, accident sickness insurance, anything along that line, we're always talking about after-tax dollars because we want the benefit to, in fact, be totally tax-free. Okay, so let's move on. Another very important notion is what we call a capital dividend account. Now, this account really only applies to Canadian-controlled private corporations. In other words, these are not accounts where the stock is actually traded on the TSX or the TMX or the New York Stock Exchange. That's not where it works. Okay? This is really for private corporations. And as I said, it is Canadian-controlled private corporation, what they call a CCPC. And so basically, if it is a Canadian-controlled private corporation, then you have a capital dividend account. That account is referred to as a notional account. In other words, it's not a real account. In other words, you don't go to the TD Bank, let's say, or whatever, so, okay, I want to open up a CDA account. It doesn't really exist. It's a notional, a virtual account, which is only used when, in fact, there is a capital dividend that actually has to be paid. Now, there are a number of sources of capital dividends. So the two examples that I want to use this evening is the non-taxable portion of capital gains. So let me explain. Let's say that you bought stocks, let's say, for $100,000 or a piece of property, whatever, and you sold it for $500,000. Okay, so you made a $400,000 capital gain. 50% of that will be tax-free, and that will go into the non-taxable portion of the capital gains. The other 50% you're going to have to pay tax on. So you see, the non-taxable portion of your capital gain, which is the 50%, automatically will go into the CDA account, from which that money then to be paid out to the owners, the shareholders, as dividends, tax-free. The other thing that's available, of course, is life insurance death benefits. So if your company owns an insurance policy on your life, so the example we got here is XYZ Inc. owns and is the beneficiary of $1 million life insurance policy on your life. The adjusted cost base, and that, of course, is what was the premium that the company paid. Well, the premium in all these years, let's say, paid $300,000. So the cost of the insurance was $300,000 over so many years, whatever, in our example. And so therefore, the ACB money is, of course, always tax-free because that's simply a return of your own money. So the only thing that goes into CDA is the excess. So in our example, the excess is $700,000. You've got $1 million policy. It costs $300,000 in premiums. So therefore, $700,000 will flow to the CDA account, totally tax-free. And therefore, that $700,000 then can be paid out once again as dividend to the shareholders, totally tax-free as well. Now, like I said, there's all kinds of other things that can go in the CDA account. But for our purposes and for exam purposes, all you need to really know is that there's a capital gain, the non-taxable portion of the capital gain, and the net value, basically, of the life insurance policy. The flow of the money, let's say in this example, $1 million minus the ACB, that also flows into the CDA account. Okay, so when it comes to registering, non-registered money, okay, basically in Canada we have three types of income that you could receive. So if you've invested, let's say, $100,000, what kind of income could you get? Interest, of course, is the first one, which pretty well everybody's familiar with. The problem with interest, of course, is that it's 100% included. In other words, it is taxed at your marginal tax rate. There is no tax break whatsoever. So if you earn $100, you got to pay tax on $100. If you own $1, you ought to pay tax on $1, basically. So interest is taxed right from the first dollar. Dividends, on the other hand, get preferential tax treatment. Now, it's beyond the scope of this lesson to actually talk to you how dividends are actually taxed. But the important thing for you to know is that dividends do receive a preferential tax treatment because they have what's called a dividend tax credit. So therefore, not the entire dividend is taxed. Unlike the interest, which is entirely taxed, the dividend you'll see there's a portion of it which is not taxed. Okay, but like I said, it's beyond the scope of this particular lesson. Just know that dividends have a preferential treatment under the Income Tax Act. And the last one, as we had talked about just moments ago, is of course the capital gain. The 50% inclusion rate, what we call, is in fact tax-free. So only 50% of the capital gain is taxed. That's called the taxable capital gain. That's the only part. So once again, I go back to my example of the $100,000 that you invested. You put in and it grew to 500. You got a $400,000 capital gain. 200,000 will go into the CDA tax-free. The other 200,000 will be taxed at your marginal tax rate. So if you're in a 30% tax bracket, for example, 30% of $200,000, $60,000 will have to be sent to CRA. That's basically. So those are your three different kinds of income that you can earn from your investments: interest, dividends, and capital gains. And as I said, we're not really going to spend any time talking about dividends, but you must know about interest and you must know about capital gains. So I urge you to make sure, if you want further information on that, not only is it in Volume 1, the life insurance volume, but also remember that you also have a fifth module, which is the taxation module. You may want to review that module as well, because we won't have time to go through that in these sessions. Let's move forward. Now, as I said, we have non-registered money, which we just talked about, but it's also second kind of money, which is what we call registered accounts. And these are, of course, monies that are to be used primarily for retirement purposes. Okay, so when you look at registered, think of retirement, basically. So the purpose really of registered accounts is to actually save money for your retirement. And because it's registered money, it will be pre-tax dollars, okay, rather than after-tax dollars. So registered money is always pre-tax dollars, and non-registered money is always after-tax dollars. So the type of tax benefit will basically the tax deferral on the principal and the income earned in the account. In other words, that interest, dividends, or capital gain that normally in a non-registered account you would have to pay tax on right away, you can defer that tax all the way until you actually retire. At that point, then of course you have to start paying your tax at that point. So you're basically deferring your tax, not getting away from the tax, but you're deferring your tax. So examples of retirement accounts, which once again we will be talking about in later sessions. I think the third session, the third week of November, we'll be talking about these products specifically. But for our purposes right now, registered money basically is RRSPs, RRIFs, LIFs, LRIFs, RPPs. Those are all vehicles that once you invest money in there, you don't get T4s or T5s or T3s or anything along that line. Okay, it's all tax sheltered money. There's also a tax deferral on income only. In other words, you can't deduct it, the premium, but you can certainly defer the growth. And that is RESP. Some of you may actually have RESPs for your children or something. And of course, RDSPs Once again, we will be talking about these registered plans later. And the last one, which is a relatively new plan, it's since 2009, it is a TFSA. So these are all plans that technically are registered in the sense that when you invest money in there, the actual growth is not taxed immediately. It actually deferred until you actually take the money out at the other end and everything. Okay? So that's essentially enough about sort of taxation and everything. Let's move on now to a situation which is kind of unique in Canada, and that is what we call a capital loss. If nobody wants to lose money, obviously, but we do know that stocks go up, stocks go down, things of that nature there. So the government of Canada basically allows us some basically income tax break, you might say, if you in fact lose money. So capital gains gets a preferred tax treatment, as you know, which basically says 50% of the gain is the only part that's income. The other 50% is tax-free. So we know that. We just talked about it. However, as I said, you could have a capital loss. So therefore, capital losses are adjusted against capital gains in the same year. So for example, if you had Air Canada shares that went from $10 to $20, that means you had a capital gain of $10. And let's say that you had WestJet stocks and it went from $10 down to zero. That means you lost $10. So basically one offsets the other, and at the end, the result is you have no tax to pay whatsoever. So basically, capital losses are placed against capital gains in the same year, or they could go back actually 3 years. So you can actually go back. So if you made money last year, for example, but you lost money this year, you could take that loss back to last year and get a substantial tax refund and everything else. So we can go back 3 years. You can also carry forward these losses indefinitely. So if, for example, you have no losses, you have no gains this year, so therefore, obviously, you can't put in your loss, because unless you have a gain, you can't have a loss. So this doesn't work that, because you have to have a gain. But let's say next year you do, or the following year you do. That doesn't mean that just because you lost money this year, that's it, it's over with. No, like I said, you can take it back 3 years or carry forward that loss indefinitely. And the day that you die, all your capital losses can be brought forward against all income, not just capital gains, but against all income. So it basically, it's really, really very good for your estate if they have these capital losses. You've never been able to use it while you were alive. At death, all these capital losses basically can all come together, and they'll go against all income, not just capital gain. So that's sort of one of the nicer things about the Income Tax Act, is that they understand that your stocks go up, stocks go down, in which you could lose money, and how do we make sure that you, as a client, as a consumer, are protected against those losses and everything. Okay, so the other area we have to look at is what we call a disposition. Okay, disposition, and that is a disposition basically means when you sell something, when you get rid of something. Okay, now we all think in terms of the fact that an individual disposes of properties they may own. So another example, which is a really common example, let's say you had a cottage, you bought a cottage, and the ACB on that cottage, in other words, the cost of you buying the cottage was $100,000. When you sold that cottage, the fair market value was $400,000. Okay, so you had an accrued capital gain of $300,000. So the taxable capital gain, it will be $150,000. Okay, that's your tax. Remember, $150,000 of that will be tax-free. The other $150,000, you're going to have to report that. And let's assume again that your marginal tax rate was 40%. So that means you have to pay tax of 40% on that $150,000. So when you're actually doing that, you'll see there that what ends up happening, of course, is that you're going to end up paying, let me just go back to my previous slide there. You're going to end up paying $60,000 in tax. In other words, 40% of $150,000 is $60,000. Okay. Now let's assume that it's you as a father, you've got this property and you would like to give this property to your son. So that's perfectly fine. There's nothing illegal about that. And still, even though you gave it to a family member and everything else, you still have to pay that tax. In other words, if you give it to your son, your daughter, or anybody else other than your spouse, which you'll see in a moment, you have in fact disposed of the property. Even if your son never paid $1 for it, in other words, strictly a gift, it doesn't really matter. As far as Ottawa is concerned, you have disposed of that property at the fair market value, and so therefore you as a father will be charged $60,000 taxes on this particular transaction. Of course, your son now receives the property at $400,000, and that property now has an adjusted cost base for your son. In this case here, $400,000. But stay with me on this because it gets a little more complicated. So let's go on to the next slide. So once again, we go back to the same thing that we have a cottage, $100,000. It's going to $400,000. Accrued gain of $300,000. Capital gain of $150,000. But this time, what you decided to do was not to give it to your son. What you decided to do was to transfer ownership of the property to your spouse. Now, this is where it becomes interesting, okay? In that with your spouse, in actual fact, what happens is there will be no taxation. In other words, in a spousal rollover situation, you can give your property over to your spouse and there will be no tax implications whatsoever. So there is a spousal rollover, but there are no children rollovers. So if you give it to your son or your daughter, it is just the same as if you gave it to a third party. You're going to end up having to pay the tax on that. Whereas if you rolled it over to your spouse, either while you were alive or on death or whatever, there is a provision on the Income Tax Act that they call a spousal rollover. And so therefore, the tax will be deferred till the day that your spouse also passes away. And so therefore, the adjusted cost base, as you see there, in actual fact, your spouse will receive the property at the same ACV that you actually purchased it at, the $100,000. So the beautiful thing in terms of being married is this whole question of spousal rollover, in that there are ways and means of deferring taxes until your spouse actually passes away. In other words, until the second person dies. And this is where we get into joint last to die policies, for example, so that when the last spouse dies, there's enough money there to pay the taxes so the children will receive the cottage on a tax-free basis. But again, we're getting a bit ahead of ourselves. But you can see that a spouse obviously has preferential treatment under the Income Tax Act, whereas your children, your siblings, and all that, third parties, they do not have preferential treatment. Only a spouse has preferential treatment. So, what happens when you die? Okay, so we talked about a living situation, but what about when you die? So, when you have a situation where in actual fact you're dead, okay, you are deemed to have disposed of all your worldly property at the fair market value upon your death. So there is what they call the deemed disposition. In other words, death triggers a deemed disposition. So even though you actually never sold it, the reality is that that's the time when the taxes have to be caught up. In other words, upon your death, Ottawa basically does a complete accounting and say, okay, we've allowed you to defer taxes all these years. Now you're dead, it's time to pay up. Basically. So in the example here, the same thing is $100,000 ACB, fair market value $400,000 at the date of death. You have $300,000 accrued capital gain, $150,000 is tax-free, the other $150,000 is taxable. You're in a 50% tax bracket, let's say, so $75,000. So your estate will have to pay $75,000 to CRA in order to make sure that that property stays in the family. Otherwise, the property is going to have to be sold or whatever, and of course, that leaves the family. In other words, the capital gain upon death is the fair market value at the date of death minus the ACB. Fair market value, of course, in this example is $400,000, and the ACB was $100,000. Okay. Now, a draw situation. Once again, the spouse will receive this on a tax deferred basis. In other words, the second person that the taxes have to be paid. will be no tax. So all we're saying is that sooner or later you do have to pay your taxes, and that's all this to it. So once again, death triggers that deemed disposition. So the exemptions in Canada for the capital gain, there are a few areas where you do not have to worry about capital gains. Okay, the first one, of course, is your principal residence. And remember, in Canada, you're only allowed to have one principal resident per couple. So if you own a house and a cottage, you need to decide which one of these properties will be your principal residence, because the other one will be considered an investment, and then of course that will be subject to capital gain. So you have to decide basically which one of your is your principal residence. Okay? If you own a Canadian-controlled private corporation, you are allowed to take $800,000 lifetime capital gain exemption on that capital gain, or a small business, like I said, a Canadian-controlled private corporation, or farm or fishing, fishing property. Now that 800,000, by the way, is indexed. So this year's, I believe, is about 833,000 or something. So it is indexed to inflation. So it changes every year. But the point is that up to that amount, at the date of death, okay, or the date that you actually sell your business, for example, you are allowed to take 800,000 plus out of the business without having to worry about any kind of taxation whatsoever. The rest of it, of course, you will have to pay tax on that. Life insurance death benefit, of course, is always tax-free. We always know that because we pay our premiums after tax dollars, then the benefit, of course, is tax-free. TFSA is also tax-free. You can't deduct the premium that you're depositing. The money that grows tax-free, and when you take out the money, is also tax-free. And of course, lottery winnings, any windfalls, inheritances, things of that nature there. Okay, casino winnings and everything. All of that, of course, will be in tax-free. So any of you who won the lottery last week at $40 million, you don't have to worry about reporting that because it is entirely tax-free. Okay, so when a person dies, of course, they have what's called an estate. Every one of us has an estate. And basically, I get this question all the time. So what is the definition of the estate? Basically, in a nutshell, the estate is anything that has your name on it. So if all you've got is your car, that's part of your estate. It's as simple as that. Anything that you own, it forms part of your estate. It's really as simple as that. So what makes up the person's estate is property and property rights of the deceased. In other words, it's got your name on it, you own it, so therefore it's part of your estate. And as I said before, at death, you are deemed to have disposed of all your property at fair market value, whatever that means that fair market value happens to be. Okay? Now, the estates can be subject to probate. In other words, there's some properties where the will, for example, has to be probated in order to prove that it is your last will and all this sort of stuff there. And of course, you have to pay tax. So for those of you who are in Ontario, it is 1.5% of your estate value. So if you have $1 million estate, it's $15,000. Probate is your fee, basically. Okay? You also, of course, have to pay your capital gain tax. Remember, all that deferral that we've been talking about eventually is going to catch up with you anyway. So the estate will have to pay any kind of capital gain taxes. Okay? And of course, you have to pay your creditors. Okay, of course, secured creditors such as the bank, your credit cards, all this sort of they're what we refer to as secured creditors, and then of course unsecured creditors, and then the remainder being your beneficiaries and everything else. All of those people will be coming up to the estate, essentially saying, the handout, I want, basically. Okay? So after tax and creditors' estate is distributed. Okay, basically. What we're saying is that when a person dies, they die two ways, you might say. They die what's called testate, which means they die with a will. Okay, so in other words, if you in fact have made a will, you have decided how you want your estate basically divided up upon your death. Okay? So therefore, the province of Ontario, let's say, or British Columbia, or wherever you may be, okay, has no say in all of this. In other words, you have decided upon my death, this is what I want to happen. So therefore, if you die with a will, you're dying with the called testate. If you die without a will, which we do not recommend, of course, is you die intestate. In other words, everybody has a will. It's either the one you made yourself or the one the province makes for you. And the one the province makes for you may not be the one that you prefer. because obviously it may not necessarily fit your particular situation in terms of how you would have distributed the estate. Okay? But because you never told us, you died interstate, so therefore the province basically steps in and says, okay, here's how we are going to divide up the estate. Okay. Now there's certain things obviously that may be subject to taxation, may not be subject to taxation. Okay. So proceeds of life insurance, RSPs, RIFs, RPPs, TFSAs are subject to taxation and creditors if you leave the estate as a beneficiary. And that's important. If you leave the estate as beneficiary. So if you leave the estate as life insurance policy to your estate, or RSPs, or RIFs, or RPPs, TFSAs, and you name the beneficiary as your estate, then all of that will be taxed, okay, accordingly at the estate level. That's why we always recommend, inserting the life insurance industry, we have the wonderful privilege of being able to actually name beneficiaries, name preferred beneficiaries, basically, that bypass the estate. So a nice way to bypass the estate is to actually have a named beneficiary, such as your spouse or your children, your grandchildren, your mother, your father, that kind of stuff there. Okay, if you name them as beneficiaries, then it does not go to the estate, so therefore the creditors cannot chase after that money. But if you name the estate as the beneficiary, then unfortunately creditors can chase that, because the estate is subject to creditor tax, is subject to taxation. So cautionary note, make sure that your client are aware of the danger of naming the estate as beneficiary on any of these investments. You should always have a named beneficiary. So things that bypass the estate, which is what we just finished talking about, basically, is a property, for example, that has joint tenancy with the right of survivorship. So, for example, if I and my wife own this house and we own it on a joint basis, that basically means that if I pass away, my wife automatically steps into my shoes and she now has the house. Okay? So whenever you have a bank account or any kind of account or a house or cottage or whatever, what that is actually registered on a joint tenancy with right of survivorship, when one person dies, the other one automatically steps into shoes. So there's what they call that spousal rollover, basically, it's a rollover provision, which means you can defer the taxes further until the second person actually passes away. Okay? So the spousal rollover is a key element of basically income tax planning and everything else. Okay? And as I said before, if you name a beneficiary, in other words, not the estate, all of the following products will bypass the estate. Will bypass creditors and everything. Okay, so life insurance, like RSPs, RIFs, RPPs, TFSAs. Okay, as long as that money goes directly to the beneficiary because they're named as beneficiaries, then we're good. If you name as the estate, then obviously we've got a problem. Okay, so again, I urge you to check that out with your clients on any existing insurance policy that they may have. They may not be aware of the danger of naming the estate as the beneficiaries. Okay. The other thing you should know about the insurance industry in terms of monthly payments, most people like paying their premiums on a monthly basis. It's monthly pre-authorized. It's very simple. It's painless, that kind of thing there. However, you have to understand that because it is monthly, then obviously we have to have what's called a modal premium. And so basically the formula is the monthly premium is the annual premium times the modal factor. For most insurance companies, the modal factor for monthly premium is 0.09, as you can see there on your screen. Okay, so let's say that your annual premium is $2,000. Okay? But the guy said, no, I can't afford $2,000. Can I do it monthly? The answer is yes, but it's going to be 2,000 times 0.09, and that is $180 is going to be per month is going to be the premium. So now, when you do the math on that and you multiply the 180 times 12, you discover that the annualized premium is $2,160. In other words, there is a premium, there is a surcharge that you must charge your client if they decide to pay for their term insurance, their whole life policy, or the disability policy, or whatever it is on a monthly basis. They should be aware that they will be paying a little bit more, basically, because the insurance company is essentially financing, you might say, that $2,000 premium. And so therefore, they have to get paid. They have to get that opportunity cost, you might say, reconciled. And they reconcile it by charging basically 0.09 times the annual premium. So the annualized premium in this case is 2160, whereas the annual premium is in fact 2000. An interesting twist, however, is that universal life, as you'll see later, universal life, you simply divide by 12. It is the only product that the insurance companies sell, the only life insurance product that the insurance companies sell that does not have a modal premium. And as you'll see later, the reason for that is because universal life is predominantly an investment product that happens to have a term insurance rider attached to it, you might say. Whereas all the other products are in fact true insurance products, so therefore it's a modal premium. But because universal life is really an investment product that happens to also have a rider, which is an insurance component to it, you simply divide it by 12, and that's it. So universal life, no modal premium. All other insurance products sold out there, there is a modal premium. Okay, so let's move forward. So let's take a look at term insurance first. This is, of course, the product that, for younger people in particular, the vast majority of people will buy term insurance. That's really what they will do. Okay. Term insurance, the beautiful thing about term insurance is that it's relatively inexpensive. Okay, so if you're dealing in a younger market, millennials, things of that nature, the expenses that they may have are very high. In other words, if you're living in areas like Toronto, Vancouver, Calgary, things like that, you all know what the mortgages are like. You all know what the price of houses are. And so therefore, they may be looking for a great deal of coverage, but don't have very, very much money. So term insurance is a great way of doing it. So basically, when we look at term insurance, there is obviously operating margins that have to be covered. Those are what we call policy fees. And so we have to cover the administration costs, commissions for you as a salesperson. We have obviously underwriting, and of course, the insurance company have to make money as well, so profits. Right? So essentially what happens is that the insurance company will look at the cost of the insurance, in other words, the monthly cost, basically, times essentially the policy fee, and that will be the actual premium that the client will actually pay for. So in the example we have here, let's say that the annual premium was $194 for, I believe it's 100,000 of coverage, but that's neither here nor there. That's not important. So the annual premium is $194, and the modal premium will be 0.09. So the consumer, your client, will pay $17.46. Okay. One of the nice things about term insurance, of course, like I said, it's relatively inexpensive. The problem, of course, with term insurance is that it has an expiry date. In other words, it will be term to whatever, term to 65, or term to 75, or 20-year term, and all that. So therefore, unlike permanent insurance, which covers the client for the rest of their lives, term insurance is in fact temporary insurance. So you have to be aware of that. That there is a time limit. So if the client dies within that time frame, then of course the policy will be paid out. At the end of that time frame, then it is the policy will have expired. So if the client dies after the term expired, there is no coverage whatsoever. Okay? Essentially, there are two types of term policies. There's what's called level premium. In other words, the premium remains the same all along and everything else, okay, forever and a day. So you're paying a little bit more upfront, as the chart is saying there. Basically, what that chart is saying here is that to levelize that premium, basically, you here's your cost right here at the bottom, but you can see you're actually paying a little bit more. But eventually, that little bit more that you're paying now pays for the premium in the future, when in actual fact, you're actually older, and therefore the cost of the insurance will be that much higher. Right? So it avoids the shock, you might say, of a much more bigger premium later on in life. And of course, the other one is YRT, which means that it goes up every single year. Yearly renewable term insurance, it goes up every single year. Sometimes it's 5-year renewable, sometimes 10-year renewable, whatever. So the point is to say it's 10-year renewable, which is the most common one. That means that every 10 years the premium goes up. Okay, essentially, every 10 years it just simply goes up. But again, later on, it can be prohibitively expensive as well. So it's something you need to make sure your client is aware of. that's the kind of thing that can happen. Okay, so a lot of people like the idea of having a consistent premium. In other words, I want to know exactly what it's going to cost me forever and a day. I don't want any surprises, that kind of stuff there. So the level cost of insurance concept is very, very important. Okay, so terms 100, for example, which is permanent insurance, as you can see by the chart that we're looking at here, you can see that level premium. So let's say that premium was $1,000 a year. It will always be $1,000 all the way through. However, if you look at the light green part versus the sort of bluish color bottom of it, you'll notice that in the first year, you're really paying a much, much higher premium than you really should be paying. In the second year, you're paying a little bit less, and so on and so forth. So what you're really doing with that green part here is you're actually sending money ahead of yourself, so that at the later date, so over here, let's say when you're in your 50s and your 60s, where the premium really could be quite substantially higher, the insurance company has a reserve of money because you've sent money ahead of yourself, they've invested that money, and so therefore the end result is that that premium will continue to be $1,000. It will not go up at all. So that's why this increase here, you don't have to worry about that increase. So the cost of the insurance continues on going up. But because you paid, you might say in advance, you don't have to worry about those costs at all. So the level concept is a very interesting idea for the life insurance industry because, like I say, most people do like the idea of knowing so they can budget properly and so on what their future premiums will be like. So essentially, you pay a little bit more upfront, but you really save a lot more later on. So it's the same old story: pay me now, pay me later. Obviously, if you pay later, it's going to cost you more. It's really as simple as that. Okay. So with whole life insurance, basically what we're saying here with whole life, which is a very common type of product. What you've got essentially is a permanent insurance, like the terms 100, okay, basically. And the name whole life is really important because it means that you're paying a premium for the whole of your life, and you're also covered for the whole of your life. Now, most companies, what they'll do is they'll stop premiums at age 100. However, some companies will pay out the amount of money at age 100, or in some companies will say, no, until you die, when you die, we'll pay it out. In other words, if you die 110 or something, we'll pay it out. But we will not take out any money from age 100 onwards, okay? In other words, you're fully paid for it, everything else. So once again, we look at the level concept here. And let's assume that this was 500,000. I believe it is 500,000 coverage. So you can see the insurance being the green part and sort of the, reddish, whatever, mauve color, whatever, there, that is the reserve. Okay, so as the years go on, as you're paying your premium, you're building up a substantial reserve so that at age 100, the amount of money or the amount of reserve that you've got is equal to the face amount. So if you look at the chart on the right side here, you'll see that 10 years from now, in other words, this started at age 30, at age 40, you got $30,000 worth of reserve, $50,000, at age 50, 100,000, so on and so forth. And then at age 100, you've got $500,000 in reserve. Okay? So that money then will be paid out to you. In some cases, companies will pay that out while you're alive. In some cases, they'll say, no, we're going to wait until the actual person dies. So you sort of have to look at the contract to see what the insurance company's policy is on these issues. But good thing about all of this is that everything that you see on that screen is guaranteed. Okay, in other words, if the client said to you, okay, well, at age 70, how much money do I have? And the illustration that you gave the client shows $270,000. You can say to the client, Mr. Jones, at age 70, you will have $270,000. So if you cash out, forgetting about taxation for a moment, okay? If you cash out, you're going to have $270,000. In other words, this is a fully guaranteed product. And as Canadians, we tend to like that kind of stuff. We like guarantees. We like to know where we stand. We like to know what our premium is. You know, we're very conservative in that area. So whole life insurance is an excellent product for that kind of consumer that really would like to know where they stand all the way through. Okay. Where am I here? go. So when we look at universal life, it's a slightly different type of situation. Okay, universal life, it really consists of two plans basically. It consists of an investment component and life insurance. Okay, and you'll see that in a moment. So when we talk about universal life, the first thing we look at is the fact that the client, of course, deposits money into an account. So think of this, for example, as a bank account. Okay, all of you have a bank account. When you get paid, the money goes into your bank account. Okay, and that bank account here is called the account value. Okay, so the account value is deposit of your money plus any earnings and all that is your account. From there, the insurance company automatically deducts premium tax. Now, depending on the province, that premium tax could be anywhere between 2 to 4%. Again, the consumer never sees all of this. They gave you their $1,000, they deposit into the account, basically, and the insurance company automatically takes out anywhere between 2 to 4% from that. Then they will deduct the YRT or level cost of insurance. And again, we'll look at that in a moment. You'll see what that's all about in a moment. We will deduct the policy fee. We'll deduct any riders that we have. So think of this again, is you deposit your $1,000 in your bank account and you wrote some checks. You wrote a check $100 for your Visa card. You wrote $200 for your car insurance, whatever it was. Same idea, except that in this case here, the insurance company actually does it for you. So from the consumer's perspective, they just simply deposit $1,000. All of this is done internally. So there's an actual deduction for the amount of the cost of the insurance, whether it be year renewable term or level cost of insurance, the policy fee, of course, any riders, and then whatever is left from that $1,000. So let's say you got $300 left. The balance is deposited into two different kinds of accounts, depending again on the consumer's choice. The consumer is very conservative. He may want to put some money into GICs, daily interest accounts, or bonds, or the consumer may say, no, I don't mind taking some risk. I'm young enough, I can take a loss and all that sort of thing. They can put money into mutual funds or segregated funds. Okay, so with universal life, like I said, what you really have is an investment account, which can either consist of GICs, daily interest bonds, or higher risk, which is mutual funds or segregated funds. Okay, and an insurance policy. So if the person prematurely passes away, the insurance policy pays out. If the individual lives and he's in the 60s, 70s, 80s, whatever it is, and then decides that he wants to now start taking money out from this insurance policy, then of course he's got that investment account attached to it as well. So when you look at universal life, think of it as two products. Okay? In terms of the death benefit, okay, in other words, the net amount at risk, the NAAR, net amount at risk, is equal to the death benefit minus the investment account value. In other words, if the death benefit was $500,000, but you have in your deposit account, your investment account, $100,000, then the insurance company, should that client die, is only on the hook really for $400,000 because the other 100 is already in the pot, basically. Okay, there's already investment money sitting in there. So the NAR basically is the amount of coverage minus the investment account. So in the example I just gave you, if you have $500,000 and you've got $100,000 in your investment account, then really the insurance company's liability only rests at $400,000, and that's it. So you can see as the years go on, as the investments continue to grow, the net amount of risk for the insurance company gets less and less and less, and I guess ultimately at age 100, the net amount of risk is actually zero because the amount of cash that's sitting in there is equal to the base amount. Okay, let's go on. So let's talk now about universal life. This is of course a major product, and I stress to you, please make sure you read the section in the book on this because there usually is a number of questions on universal life. So when we talk about universal life, as I said before, it's a combination of two products. Sure.
Yeah. Hey.